The NYSE American is currently closed. Trading for Nuburu Inc., ticker symbol BURU, closed on Friday, October 17, 2025, at $0.34 per share, representing a marginal gain of plus 0.85% or plus $0.0029 from its previous close. Now, here's what you likely missed while focusing on that minor price movement: the Orbit SRL acquisition, a move that is much more significant than a simple asset purchase. It represents a complete strategic reset of the company's business model away from pure blue laser technology and toward a focus on defense-grade operational resilience software as a service, or SaaS. The market is treating BURU like a beaten-down, small-cap industrial laser producer clinging to a speculative technology that has yet to commercialize effectively. The expectation is that this is a classic struggling deep tech company scrambling for cash, evidenced by its $12 million public offering in mid-September 2025 and its prior struggle with NYSE compliance warnings. The reality, however, is that management is actively engineering a massive corporate transformation, deliberately attempting to pivot to a high-growth, high-margin, defense-focused SaaS model that could fundamentally change its valuation story from a capital-intensive hardware play to a recurring revenue software services provider in a highly specialized, insulated market. This is the tension we need to explore. The stock price is trading at penny stock levels, reflecting the old, troubled company, while the boardroom is furiously working to install the foundation of an entirely new entity. The current price of $0.34 is a graveyard for many retail speculators who have seen the stock bounce between its 52-week low of about $0.12 and its high near $0.99. That massive price volatility, its weekly volatility has been cited around 33%, reflects a market grappling to price a stock with a tiny market cap, negative shareholder equity, and rapidly declining prior business revenue, all while absorbing a constant barrage of M&A news. The volume, reaching over 93 million shares on certain days recently, is enormous for a microcap and signals heavy speculation, institutional liquidation, and short-term trading interest rather than long-term investment. Just in the last month, the stock delivered a significant return of over plus 145%, suggesting that some players are clearly betting on the success of this transformation, even as others rush for the exits. That huge price movement isn't tied to a laser order. It's tied to the steady drumbeat of defense-related news. Let's look at the recent corporate activity that is fueling this new narrative. In October 2025 alone, we saw a flurry of announcements. The biggest one was the binding agreement to acquire 100% of Orbit SRL, an Italian SaaS provider focused on operational resilience, particularly for defense and critical infrastructure. This isn't just about diversification, it's a strategic alignment with a projected $2.9 to $3.6 billion market opportunity in defense and NATO organizations for operational resilience software. Orbit itself projects impressive revenue acceleration, $3.22 million in 2026, jumping to $10.75 million in 2027, and nearly doubling again to $19.29 million by 2028. If BURU successfully integrates this and its other defense-focused acquisitions, like the ongoing planned acquisition of Techni for electronic warfare capabilities, it's building a vertical, integrated defense technology hub. Think of it. A small, struggling laser company is attempting to become a defense tech contractor providing blue laser hardware, electronic warfare, and mission-critical SaaS platforms. That's a monumental shift. However, the reality check comes from the administrative and financial headwinds. Just before announcing the Orbit acquisition, the company had to address a New York American warning letter for not providing required advance notice on its dual CEO structure announcement. While they've since confirmed they've resolved the compliance issue, these administrative missteps spook sophisticated institutional investors. It's a clear signal of growing pains and a management team that is prioritizing its aggressive transformation over textbook compliance procedures. The market is hypersensitive to such warnings because the threat of delisting is a legitimate risk for any microcap stock that struggles to meet minimum listing standards. And while the recent issue was procedural, they've had other compliance issues in the past related to stockholders' equity. For a business with negative net income, losing around $37 million in the trailing 12 months and having negative shareholder equity, every piece of negative news amplifies the downside risk. This is a speculative bet on a complete turnaround, and the current price is a reflection of the significant operational, financial, and legal risks involved in executing such a dramatic strategic pivot. The old business versus the new focus. To understand the expectation versus the reality, we need to quickly anchor ourselves in what BURU was. Nuburu Inc. was founded in 2015 as a pure-play industrial laser company, specializing in high-performance blue laser. Blue lasers are better than traditional infrared for welding highly reflective metals like copper, gold, and aluminum, which are essential in fast-growing sectors like EV batteries and 3D printing. The technology is genuinely advanced, addressing real manufacturing limitations. However, the commercialization scale hasn't materialized to sustain the public entity. Past financials show the problem. In 2024, the company saw total revenue drop to a mere $152,127, a precipitous decline of over 92% from the year before. The expectation of a breakthrough blue laser technology becoming a major industrial machinery player has, so far, fallen dramatically short of reality, culminating in heavy losses. This financial distress is precisely why the transformation plan, led by Executive Chairman Alessandro Zamboni, is so urgent. The entire strategy is a capital-raising and acquisition campaign to immediately build a revenue-generating, defense-focused core that can subsidize and strengthen the original laser technology by finding immediate applications in the defense sector. They've completed a $12 million public offering to help fund this transition. This move from a low-revenue, capital-intensive hardware manufacturer to a service-based defense tech integrator with recurring software revenue is the core of the potential upside. The market is currently valuing the company based on its old failing laser business. If the market begins to price in the projected revenues from the acquired SaaS businesses like Orbit, the current stock price could appear severely depressed. Let's be clear, this isn't just about swapping one business for another. It's about combining them. For instance, the original blue laser technology can be licensed back and applied to defense applications where it offers unique material processing advantages, creating a synergy with the new defense-focused assets like Techni's electronic devices and Orbit's operational software. The defense market is an attractive new home because of its deep pockets and long-term contracts. The defense and security market as a whole is growing robustly, with defense spending expected to expand from about $491 billion in 2024 to $527 billion in 2025. That's a strong macroeconomic tailwind to ride, a far cry from the volatile, cyclical industrial machinery sector. The path ahead, catalysts and critical risks. The short-term price movement in BURU will be governed by the successful execution of this complex acquisition strategy. There are several key catalysts to watch for in the coming months. First is the completion of the Orbit and Techne acquisitions. Orbit's acquisition is a two-stage process, and the successful capital subscription and final purchase by the end of 2026 will provide much-needed clarity. Investors also need to watch for the shareholder vote regarding the second stage of the Techne deal, which could involve issuing a significant portion of common stock. Shareholder approval is required, and any unexpected delay or failure would immediately crush the new narrative. A third catalyst will be the revenue updates from these new defense subsidiaries. If Orbit starts delivering on its projected revenue of over $3 million by 2026, the street will have to reevaluate the entire BURU thesis. Finally, keep an eye on any new announcements regarding defense contracts or partnerships, particularly within the NATO structure, which is a stated target market. The primary risks are not related to the technology itself, which is proven, but to the execution of the corporate restructuring. This transformation is being carried out by a small team, evidenced by the fact that the company still lists only 8 employees in some public documents, which makes the successful integration of multiple international acquisitions, Orbit is Italian, a substantial operational challenge. The capital is also constant constraint. Although they raised $12 million, the scale of their planned acquisitions and transformation requires significant ongoing financing. The risk of future dilution through additional offerings remains high to maintain liquidity and complete the deals. The fundamental health of the business remains precarious with negative shareholder equity, meaning the balance sheet is effectively in a poor state. All this means the stock's future is binary. Either the management team pulls off this dramatic, risky pivot and creates a defense tech company with a new valuation paradigm, or the accumulated financial and operational risks of the old business and the new acquisition spree overwhelm the capital structure, pushing the stock towards greater distress. The low valuation, in a strange way, reflects a discount for all these risks. The central question for anyone following BURU isn't about blue lasers anymore. It's about whether a microcap with a checkered financial past can successfully re-engineer itself into a defense tech platform. The market's expectation is a high likelihood of failure, given the historical performance and administrative missteps. The counter-reality is the sheer ambition and speed of the defense acquisition strategy, targeting high-margin software revenue and a secure, expanding defense market. That tension is what drives the volatility. Comment below and tell me,